Oil, rates, and geopolitics are pulling hard on portfolios today, as renewed tensions around the Strait of Hormuz send crude higher, push bond yields up, and challenge the AI trade in equities. You are watching vTalkInsight, Allocator's Lens Daily for July 9th, 2026, where we connect the main liquid asset classes into one cross-asset picture. Let us start with equities, where sector rotation and volatility beneath the surface are reshaping the risk landscape. In equities, the core tension is between an AI-driven earnings engine and a rates and geopolitics shock that is forcing a broad rotation beneath the index level. Headline indices have only slipped modestly, but the VIX has moved from the mid-teens toward the high teens, while volatility at the single stock and sector level is far more pronounced. That mix matters for allocators because it means risk is shifting within equities rather than simply in or out of the asset class. The most visible pressure point is in semiconductors and AI hardware. The Philadelphia Semiconductor Index is down well over 10% from its June highs, and one flagship name has fallen about 16% from its peak, erasing close to $1 trillion of market value. This is less about a collapse in AI demand and more about investors reassessing how sustainable recent record profit growth in memory and accelerator chips really is as funding costs rise for hyperscalers. Recent chip earnings were, by most accounts, driven by genuine demand rather than pure speculation, and fundamentals for leading suppliers of AI infrastructure still look robust into next year. Some investors now argue that after the pullback, valuations in names like NVIDIA and Micron look closer to market multiples than at any point in the AI boom, which could limit downside if AI capex continues as planned. Others worry that rising interest rates and weaker appetite for large tech bond deals will eventually constrain the pace of AI investment, making this a key macro sensitivity for the whole equity complex. Beyond chips, leadership is clearly broadening. Non-tech sectors in the S&P are regularly setting new highs for the first time in months, and investors are rotating toward areas like utilities, materials, financials, and healthcare alongside rails, hotels, refiners, and non-traditional banks. Energy and defense also stand out, helped by oil's 5 to 8% rally and a multi-$100 billion step-up in NATO-related defense spending over the 2024 to 2026 period. Regional dispersion is stark, especially in Asia. South Korea's Kospi has slipped into bear market territory, with intraday swings amplified by retail-driven leverage products that are now forced to delever as chip stocks sell off. Foreign capital has been exiting Korea, and flows have rotated into Hong Kong and Chinese tech names, while indices like the Hang Seng Tech benchmark have outperformed, underlining how quickly leadership can migrate across markets. Offsetting those stress points, macro and earnings glass still looks more half full than empty. Profit margins across the major indices are at record highs, no longer only in technology, and there are early signs of margin expansion in other sectors. Consumer spending on travel and events remains firm, and the global growth outlook has been left broadly unchanged by forecasters, even as geopolitical risks escalate. For equities, the key watch items now are whether AI capex plans are revised down, whether energy and bank earnings see lasting upgrades from higher oil and defense outlays, and how far the rotation away from concentrated megacap leadership continues. Turning to rates, bond markets are repricing toward a higher for longer path as the oil shock revives inflation anxiety. Brent has climbed sharply. The crude curve has flipped into backwardation as traders price disruption risk, and inflation break-evens have pushed higher. In the United States, yields have risen across the curve, with the 2-year note back near 1-year highs, and that repricing sets the tone for discount rates across all risk assets. On policy, the Federal Reserve is grappling with stubborn services inflation outside housing and uneasy survey-based inflation expectations. Minutes from a June meeting are expected to show that nearly half of policymakers still see scope for another hike this year if inflation does not fall back toward target. At the same time, the new chair has signaled a dislike of explicit forward guidance, which leaves markets more exposed to each data point on jobless claims, wages, and housing. Europe is facing its own version of this story. Government bond yields, they are rising, especially around the 5-year point, as higher oil prices intersect with political risk in France. French government yields have jumped relative to German bonds after Marine Le Pen confirmed her run for the 2027 presidency, reviving concerns about fiscal sustainability and adding a regional spread layer on top of the global inflation premium. The cross-asset implication is that higher real yields and a stronger dollar are tightening global financial conditions, particularly for Japan, Korea, and more leveraged emerging markets. There's a growing recognition that in scenarios where both stocks and bonds sell off together, the traditional diversification benefit of a simple 60-40 mix can weaken significantly. That is pushing more attention toward explicit downside protection and strategies that can carry risk through episodes when duration and equities are hit at the same time. In credit, the story is one of higher funding costs meeting a heavy refinancing calendar, with stress showing up first at the margin rather than the core. Corporate bond supply is expected to average around $1 trillion a year over the next 3 years as companies roll existing debt, locking in meaningfully higher coupons than in the last cycle. That is supportive for long-term carry, but it also raises the hurdle rate for new investment projects and squeezes weaker balance sheets. Recent high-profile deals underline the shift in investor appetite. A large $25 billion AI-linked bond sale from Amazon attracted order books only about twice the deal size, compared with roughly 4 times coverage for similar investment-grade supply earlier this year, and spreads had to widen by roughly 20 to 25 basis points. Other big tech-related and space sector deals have also traded down in the secondary market, pointing to more price-sensitive demand even for marquee issuers. Under the surface, risk remains quite segmented. CCC-rated high-yield spreads have widened, but that is being read as issuer-specific rather than a systemic warning because the broader economy is still solid and higher-quality credit is stable. In Europe, senior secured loans are offering yields around 6% with tighter covenants than comparable U.S. loans, while some investors note that emerging market debt from commodity exporters has historically helped when equities sell off. What ties it all together is that as rates rise, some corporates are turning back to equity issuance, and the cost of financing the AI and infrastructure build-out is becoming a more binding constraint. Foreign exchange is being driven above all by the combination of higher U.S. yields and renewed geopolitical tension. Persistent inflation concerns and a hawkish Fed stance are reinforcing expectations that the dollar index could grind higher over the next quarter, while trend-following models continue to add to long dollar positions. Policy divergence is back in focus, with U.S. economic resilience standing in contrast to more fragile growth elsewhere. The yen remains notably weak despite some improvement in Japan's balance of payments. Dollar-yen is expected by many participants to trade in a wide 160 to 165 range, with real rate differentials to the U.S. doing most of the work and talk of intervention only becoming louder near the top of that band. In Europe, euro-dollar around the low 1-teens is consistent with a firmer dollar bias, while in emerging markets, especially Latin America, expensive valuations and narrowing carry buffers leave currencies more vulnerable to further U.S. yield moves. An important twist is the link between the dollar and U.S. equities through the AI theme. Recent U.S. current account deficits have been funded more by equity inflows surfacing from the AI rally than by foreign buying of treasuries, so a sharp derating of AI and tech valuations could weaken the dollar alongside stocks, breaking the usual safe haven pattern. At the same time, higher real yields and Fed tightening mean that traditional havens like gold and Bitcoin have not provided reliable protection in the near term, even though, structurally, central banks continue to build gold reserves as they slowly diversify away from the dollar. Commodities, and oil in particular, sit at the center of the current macro shock. The effective end of the U.S.-Iran ceasefire, U.S. airstrikes on dozens of targets, and Iranian attacks on tankers and regional neighbors have turned Tehran's theoretical leverage over the Strait of Hormuz into a more practical risk. As much as 20 million barrels per day of supply move through that choke point in normal times, and while rerouted pipelines have kept flows to roughly 70% of normal, shipping traffic remains depressed and markets are embedding a clear risk premium in prices. Recent price action reflects that mix of fear and resilience. Brent crude has jumped 6 to 8%, approaching $80 per barrel, with European gas futures also up more than 5%, yet underlying crude fundamentals are not especially tight. Soft Chinese demand, rapid electric vehicle adoption, and increased Russian exports to Asia all argue against a runaway oil market. But refined products tell a different story, with low gasoline and diesel inventories and damaged refining capacity, keeping pump prices and airline fuel costs elevated. For macro and inflation, the bigger risk is a prolonged period of oil in the $70 to $90 range that props up headline inflation without meaningfully destroying demand. That scenario could force central banks to maintain or even increase their tightening bias, feeding back into real yields, credit spreads, and equity risk premia. Gold sits at the intersection of those forces. In the short run, higher real rates and a stronger dollar have weighed on prices. But structurally, rising government debt loads, greater military spending, and survey evidence that nearly half of central banks plan to maintain or increase gold holdings underpin a more constructive long-term narrative for the metal. Stepping back across assets, today's picture is one of an oil and geopolitics shock rippling through higher bond yields, a firmer dollar, and more volatile leadership in equities, all against a macro backdrop that is still broadly resilient. Equities are wrestling with whether AI-driven earnings in stronger sectors like energy, defense, and infrastructure can offset pressure from higher discount rates and regional stress points, such as Korea. Rates and credit are absorbing a higher-for-longer inflation narrative, with political risk in Europe and heavy corporate refinancing adding complexity, while FX is reinforcing tighter global financial conditions as the dollar advances and the yen and emerging market currencies struggle. In commodities, oil is carrying a renewed risk premium and refined products remain tight, even as longer-term supply and demand forces look more balanced, and gold is caught between near-term rate headwinds and structural demand from central banks and rising defense spending. For allocators, the key watch points now are the evolution of U.S.-Iran tensions and Hormuz shipping, the next milestones in AI capex and earnings guidance, and incoming inflation data that will shape how far central banks lean into this latest energy shock. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.